Welcome to episode 30 of the Special Situations Report, a podcast by Inside Arbitrage. I am Asif Surya.
And my name is Tamanna Surya.
And today we are thrilled to have Julian Klymochko as a fourth guest on this podcast.
Before we begin, we want to state that nothing on this podcast is meant as investment advice. Please refer to our full disclaimer at the end of this podcast.
Julian, thank you for taking the time to do this podcast with us. I think I've been following your work probably close to a decade at this point. We've communicated on Twitter in the past, and it's just absolutely a delight for us to have you on the podcast today.
Yeah, thanks for having me. Excited to chat about all things arbitrage and special situations.
Julian is the founder and CEO of Accelerate, a leading provider of alternative investment solutions. Julian, we would love to have you take a few moments to introduce yourself and tell us a little bit about how you got started in the business, where you are at the moment, and your approach to investing.
Sure, sounds great. I could give you a quick life story. How much time do we have? No, just kidding. I'll be pretty quick. And, I wasn't a phenom like Warren Buffett buying stocks at 13. I didn't really have any exposure as a kid to finance or capital markets. I probably didn't discover it until it's probably around 20 years old in university. And funny thing is I started watching CNBC and I thought Jim Cramer was very entertaining. And I thought he made stocks very accessible. And, I started watching a show and following him. And he was one of the reasons that got me initially interested in stocks and capital markets, now well over 20 years ago. And at the time, I was pursuing an engineering degree, and I decided to also pursue a degree in finance as well.
Mm-hmm.
And after I took my first finance class in corporate finance, I realized that that's what I wanted to focus my career on. I really liked it, despite that was really my first exposure to corporate finance and capital markets and stocks and just learning about that. I got extremely interested and started reading, every book that I could and looking at different styles of investing and going through the same steps that I think most professional investors go through, when they're still amateurs and still learning. You learn about technical analysis, you learn about value investing, you learn about growth investing. So, you read about everything that Peter Lynch wrote and all of Warren Buffett letters and, other, even market technicians learning about what works and what doesn't. And, you start investing and trading on your own. Granted, it was less accessible back then. We didn't have like the Robin Hoods and things of that nature. And then I decided to pursue a career in finance. I was lucky enough out of school to get a job in investment banking, working on mergers and acquisitions.
Wonderful.
Which, it's really good coming from my school because I didn't go to like an Ivy League or anything. So I got a job with one of the big Canadian banks, largely working on mergers and acquisitions in the energy sector. And I was just joking with my associate portfolio manager this morning. I'm like, well, is we had a large position in our arbitrage fund in the Hess Chevron deal. So we're long Hess, short Chevron, and it was a litigated transaction, went through arbitration because Hess had a stake in this offshore Guyana oil project, and one of their partners, ExxonMobil, they made the argument that there's this ROFR, and they commenced litigation to try to halt the deal and say that they have the right to buy the asset. And ultimately, Hess and Chevron prevailed and the deal closed this morning, as basically as soon as the result was announced. And I joked to my associate portfolio manager, working on all those oil and gas M&A deals finally paid off. Early on in my career, I got really good insight into the merger process, being an analyst on deals, working on all sorts of transactions. One of the biggest ones that I worked on, I was staffed on a deal in China, went out to China, where we worked advising a large Chinese oil company on its acquisition of a large Canadian oil company, an oil sands company, which ultimately got consummated in a $15 billion transaction. So you got really good experience and got to see all the deal process inside and out and financing and things of that nature. Yeah, and also at the time, I started in the 2000s, and early on in my career, I got to experience the GFC in 2008.
Mm-hmm.
And I still remember looking at my personal portfolio, which was very modest at the time, one day, and every single stock I owned was down double digits.
Yeah.
I felt like I got a good lesson in risk and risk management early on in my career, which is always a very good thing to learn. I see a lot of speculators these days probably getting over their skis in terms of the risks that they're taking, particularly if you look at meme stocks and crypto, and those things could easily be down 90, 100%, and there's a lot of leverage there being built up. So yeah, good lesson in risk management. And so I did my a tour of duty in investment banking, and then I left to join a hedge fund, a fairly new fund, managing a pretty small pool of capital during the GFC when volatility was very high and spreads were very wide. And it was a firm focused on arbitrage. And our primary strategy was closed-end fund arbitrage, where we
Interesting.
buy closed-end funds at a discount and hedge the underlyings. So it's a market-neutral strategy. And we had very good results in 2008 and 2009. And I cut my teeth doing arbitrage in a very volatile environment. We are doing risk arbitrage as well, focused in North America, and really showcased that when stocks are tanking, you can still make a lot of money and have positive returns via various arbitrage strategies. Whether it's closed-end fund arbitrage, we're also doing merger arbitrage, convertible arbitrage, volatility arbitrage, and we did a bunch of quantitative long, short, and market neutral strategies, multi-factor strategies, and did that, and went from analyst and moved my way up to chief investment officer and ran those mandates, and then had the opportunity to go out on my own in 2018 and launched Accelerate in 2019. Initially, it was just an idea, and here we are 6 years later. We got a fairly broad alternative platform, still doing merger arbitrage, in addition to other strategies, absolute return, multi-asset, long-short equity, and private credit. So happy to chat about any and all of those. And I'm still very, very much involved in the merger arbitrage space. I manage our Accelerate Arbitrage Fund, and so I'm extremely involved in any risk arbitrage and SPAC arbitrage trades these days.
Yeah, I was going to ask if we could jump right into it. That was going to be our next question. What is Accelerate structured like, and what specifically made you opt for the ETF route as opposed to more typical fund structure? And as you mentioned, I understand you have a number of ETF strategies like the merger arbitrage, long short equity, so on and so forth. How did each of these strategies and funds develop?
That's a great question, just with respect to overall strategy, and it's something that and structure is something that I thought about for a very long time, specifically going through the GFC in 2008 when stocks were down, 30, 40%. Our fund was up 8%, and our clients were very happy. But our clients were all wealthy investors because where we're based, we offer funds in Canada. At the time, you could only offer hedge funds to accredited investors. My attitude was always, if someone's worth 50 million and their portfolio is down 50%, likely not going to change their lifestyle. But if someone has a $500,000 portfolio and it's down 50%, the likely material event, and they're not retiring as they thought. So I always thought it was unfair that the best investment strategies were only reserved for the wealthy, particularly given that I didn't come from money and my family was not wealthy. So I just thought it was really unfair where it was the people who weren't wealthy who needed these the most. And it was a result of regulations that weren't really well thought through. And so fast forward a dozen years, and then in 2018, there was a new regulatory regime in Canada working its way through the legal process that was expected to be implemented in 2019. And my idea was I was looking at the growth of alternatives. And back then, alternatives were synonymous with hedge funds. The term has kind of been co-opted by private assets, which aren't necessarily alternatives. To me, alternatives is primarily hedge funds. And, the growing popularity of alternatives, at the same time, the growing popularity of ETFs, because ETFs are a very investor-friendly vehicle. Daily liquidity, accessible to everyone, super easy to use, kind of one-click buy and sell, much more competitive on fees. And I thought with that, why has no one ever merged the two together and launched hedge fund ETFs? And I looked into it very quickly, realized that the regulations prevented it. However, with the new regulatory regime, it's basically allowed liquid alternatives in Canada via ETFs and mutual funds that was coming down the pipe. I think it was a good business opportunity to become the leader in a space that had no leading firms in it yet, because it hadn't been formed yet. So our goal was to reinvented the hedge fund ETF, and we launched in 2019 the absolute return and long short strategies, and then launched our merge arbitrage ETF in 2020, and then several others after that. So it was a fairly innovative strategy, and ultimately the hedge fund and alternative space, it's fairly competitive, and there's literally thousands out there. So with any new product, you got to think about, hey, how am I differentiated? Why should I exist over all these other firms in the market? And our value proposition is, access point and convenience, ease of use. So we offer hedge fund and alternative ETFs where investors have daily liquidity. They're open to all investors, no minimum investment, super easy to use, one-click buy and sell. So you don't have to fill out stacks of paperwork if you want to invest or get your money out. I invested in my own private funds and I hated it because it was such a pain to fill out the big stack of subscription documents, or if I needed some liquidity, the redemption forms, and then my cash 6 weeks later. That was not investor friendly. So we just made a much better vehicle. I make the analogy like it's Netflix to Blockbuster. Renting a DVD was annoying, having to go to the store and return it. People would just rather stream online. And with hedge fund ETFs, it's like, why go through the hassle of a private fund when you can have something that's better, faster, cheap? So that's a structure that we created really to differentiate and give clients and investors a much better experience. And ultimately, with more competitive fees, that results in higher performance. And that's one of the reasons why we recently ranked #1 in arbitrage by Barclay Hedge.
That's a great analogy. The Netflix versus Blockbuster, really reminds me of the time where I lost some money in Blockbuster when Carl Icahn was quite interested in the company as well. Thankfully, I did invest in Netflix after I realized it was a much better company. And so that analogy really, stood out to me. Congratulations on your ranking. You've been doing really excellent work in merger arbitrage at a time where, at least the last 2 years, things were very difficult for us on the regulatory front. And that has changed quite a bit. You talked about the Hess, Chevron merger closing. We also had US Steel, Nippon that closed. And very recently, Juniper and Synopsys, Ansys, Juniper, HPE. So many of these deals with very large spreads have finally closed, and looks like the strategy is making a nice comeback.
Yeah. The interesting thing about all of those transactions you named is each one had a different regulatory issue.
Mm-hmm.
Ansys Synopsys was China SAMR, and then US Steel was CFIUS, and then Juniper HPE was US Antitrust. Yeah, the Department of Justice. And then Hess and Chevron was this arbitration. It's like, each one faced a very unique regulatory hurdle. So it's great that they were all able to be successful.
Absolutely. Speaking of the ETF structure some more, I knew a fund manager in Seattle that ran a quantitative fund. And the nice thing about his fund was they tended to hold positions for the long term. So every quarter, I would look forward to taking a look at his 13F filing to see which new companies made the cut in his quant algorithms, and then see if these companies are worth exploring. Is this a concern for you, Julian, that because it's an ETF structure, people can see every position that you have on, which in a hedge fund structure at least would be protected to some extent until a 13F filing came out?
Yeah, it's an interesting question. And I've always had the same attitude. And you've seen, I think, investor interest in hedge fund positions decline markedly over the past 10 or 20 years. Writ large, like you see it across the industry. And some examples I'd give you is, if you remember, those hedge fund idea conferences I was on and things of that, where like David Einhorn would have an idea. If it was short, it would like plunge 20%. And if it was long, it would rally 20%. And ever since the past 10 years, like no one cares. And that's my attitude with basically every fund's position. Even Berkshire Hathaway, Buffett announces a new position. I don't think anyone really cares. And certainly no one cares about what we're doing. So there's really no reason to want to keep your positions secret. I think those fund managers that want to keep them secret, they're only fooling themselves. Like no one cares. Let's just be honest. It doesn't matter. And with that attitude, we'd rather be transparent because investors deserve to know. And it really has zero net effect because at the end of the day, no one cares.
You're right. There's so much information out there at this point, and I find it quite useful to be transparent because I get some feedback from people who follow a similar strategy, and they might see something I might not see. And that communication, that dialogue actually helps me quite a bit.
Yeah, no doubt. And people want to know what they're buying. And if you want to operate as a black box, I think that's tougher and tougher these days because there's a lot of competition. So you got to offer the best product possible, and the best products are transparent.
Makes perfect sense. You mentioned David Einhorn's idea conference at the start of that, and kind of along a similar line, in general, talking about investment strategies and processes. How do you come across ideas, either for the ETFs or for your own personal investing? Do you use screens, conferences, sell-side research, or other sources for these ideas? And then how do you go about unearthing some of these special situations as well?
Yeah, and so for the sake of this discussion, I'll focus on kind of merger arbitrage and risk arbitrage because our quant strategies are completely different, where we're not necessarily generating ideas. It's just based on multi-factor long-short rankings. So in terms of merger arbitrage and risk arbitrage, I've been doing that, close to 20 years. And my process, I don't think it's unique, but can go through kind of what I do on a daily basis. So wake up bright and early at the desk, 5 a.m., and just go through my emails. I get emails from probably most sell-side desks, and they'll have research and new deal announcements and just going through the morning news, whether it's Wall Street Journal or Bloomberg or, just download as much data as possible. After that, then I look at global antitrust filings and approvals. And then after that, I look at exchange corporate actions, new listings, delistings. And then after that, I look at the various news wires. And on the news wires, I'm looking for M&A announcements. And I think I have like a copious amounts of Google alerts. We have Bloomberg screens, persistent chats on Bloomberg. Like I said, getting all the daily updates from various sell-side desks, risk arbitrage research firms. Twitter's, or X, I should say, is a very good source as well. There's a lot of good accounts to follow. I see yours as well. You always have commentary. So
Thank
we
you.
have a myriad of sources, and that basically gets you everything you need to know in merger and SPAC arbitrage. We're very active in SPAC IPOs, and so when there's a new IPO coming down the pipe, we just get the term sheet from the underwriter. So it's important to have relationships with all the underwriters and be within their deal flow. And then, the merger arbitrage stuff. If you're following the news wires and, your Bloomberg filters and get the sell side research, you'll be aware of those. And as soon as it's announced, you open up your model and start modeling it out and start digging through the deal documents.
Got it. And that's very helpful. And it's a lot of work. I think a lot of people don't realize just how much work it is to understand each of these deals, even before you can come to the point of trying to make a decision whether this makes sense or not, and what kind of probability you can assign to each of these deals. Because that part is subjective, but before you can get to that subjective part, there's so much work that goes into trying to get to that position to make that call.
It's pattern recognition. And,
Yep.
I've analyzed about 5,000 M&A deals over my career, and there's just a ton of pattern recognition. And I think at this point, I can tell relatively quickly if I like a deal or not. There's certain things that I see right away that will be an immediate pass. So we're relatively selective as opposed to others. I know some take a systematic approach, try to harvest the merger risk premium by buying every deal. We don't do that. We're fairly selective. We take more of a quantamental approach, I take it. So it's a mix of quantitative and fundamental analysis. Not necessarily fundamental analysis that you'd traditionally see on an equity position, but it's more fundamental analyzing the various risks, antitrust risk, financing risk, boat risk, things of that nature.
So, over these 5,000 deals that you've looked at, what are some of those patterns you look at, and what are some of these immediate red flags that make you pass on any such deal?
Sure. So first, we look at deal size. We want to look at liquidity. If a deal is kind of too small, we're always like the number one worry and the number one concern is risk and getting out if things go wrong. So you want to make sure there's sufficient liquidity in the target such that if something goes wrong, you can get out. So first, I look at the underlying kind of pre-deal liquidity and the size, just to make sure that it's investable from an institutional perspective. If you're a personal investor, then obviously you can do the microcap stuff, but you definitely have to judge the liquidity. And then second, you look at, who's the acquirer? Are they credible? If it's a cash deal, do they have the money? That's very basic. So if they're a strategic acquirer and a public company, you look at their balance sheet. Do they have this cash on the balance sheet, or do they have, fully committed financing from a credible source? So buyer credibility is certainly very important. Either as a strategic buyer, you can look into their financial statements, or a private equity buyer. Do they have the money? It's that simple. So, if it's obviously a Blackstone or a KKR, they're good for the money because they've got tens of billions of dollars in private equity funds. Or if it's a large strategic buyer, they're good for the money. So buyer credibility is extremely important. And do they have a track record of success in closing transactions? And then if it's an all share deal, and obviously if the buyer credibility isn't there, if they're a private equity firm that we've never heard of and there's no record of them raising capital, or if it's a strategic deal where their financing is iffy, that's another easy pass.
Yeah.
Another thing is if it's a share deal. Sometimes on share deals, if the acquirer is issuing a certain amount of shares, they require a vote on their end. So that is a buy side vote. And buy side vote incorporates additional risks. So you have buyer vote risk. If you look at the buy side firm's share price on deal announcement, they tend to decline. And if they decline far enough, shareholders may vote it down. And that's a very easy way to blow up a deal. So you got to be aware of that. In addition, I think that offers activists, and I've seen this several times, a very easy trade. They go long, the acquire short the target and agitate to blow up the deal. So they do the reverse, they call it like, Chinese spread or whatever it's called. And so that's a risk. But primarily when there's a buy side vote, in my opinion, that puts the acquire in play such that it provides a path for a hostile acquirer to buy the acquirer. And if that happens, the trade completely blows up, where you're short and the acquirer surges, and of course you're long on the target tank. So our rule is that never invest in a merger deal if there's a buy side vote, unless you're very certain that the acquirer is not going to get taken out. And after that, regulatory, that's another one. So if it's a big deal and you know that there's going to be significant antitrust risk, that is something that definitely requires some thoughtful analysis. In addition, foreign investment risk. If it's a foreign buyer and US target, there's CFIUS. If it's a Canadian target, there's Investment Canada. That's another risk. And it really is sector specific. So regulatory can be very complex and perhaps requires the most analysis. And then another easy thing that we look at is needs to be a definitive agreement. If it's a letter of intent or a non-binding indication of interest, then there's nothing binding there. And those typically introduce market risk. And then, so those are an easy pass. And lastly, when a deal is announced, they typically say in the press release, or at least the 8K, and certainly in the merger agreement, what are the conditions? You look at the conditions and there's, a vote, there's regulatory approval, and there could be additional conditions. There could be a market out. Sometimes you see a market out where it'd say, if the Dow Jones Industrial Average declines 10%, we can get out of this deal. So that's an easy pass, in my opinion, just because you can't forecast that. Or there's other, I've seen transactions where they're subject to approval of like a different share class or debt holders, or think of things of that nature that require additional consideration. So there's kind of all these things that's on our checklist that we need to take a look at prior to doing further due diligence on a transaction.
And you're right, Julian, especially on the regulatory side, the amount of analysis that requires, sometimes you need a lot of legal talent to look at it. But one of the things that worries me the most is headline risk. So if it's a deal between two consumer products companies, you're going to have like Elizabeth Warren or Bernie Sanders suddenly speak up. And whether it's Dick's Sporting Goods acquiring Foot Locker or any of those kind of consumer deals, very likely that they're going to agitate for the deal to be potentially looked at or blocked. So that's one thing I look out for.
I always joke that on deals with that headline risk that we're always just one Elizabeth Warren letter away from the spread blowing out. And that could provide an opportunity as well. Certainly, there's situations that there's an opportunity for political risk, and US Steel was a shining example of that headline risk and that political risk, particularly around a very contested election.
Yeah, and that deal was interesting because that second CFIUS review that the Trump administration asked for was really a canary in the coal mine for the likelihood of that deal going through, increasing quite a bit.
Yeah, I don't think that historically CFIUS has been the be-all end-all. If they block it, that deal is, dead as a doornail. But this time we had an unprecedented reevaluation under a new president who also said he's going to block it, but the deal was ultimately successful. So that is one for the history books and a very interesting precedent transaction.
Indeed.
Things are changing very rapidly. Even now, speaking of headline deals, I was looking at the Mars and Kellanova deal earlier, And for whatever reason, we didn't see like Elizabeth Warren come through. The FTC actually approved the merger. So we're seeing things loosen up maybe a little bit on the US end. But then all of a sudden, the European Commission came in on this consumer products deal and have started up an investigation on that side. So it's maybe like a shift in terms of international bodies looking at these deals as well. So very much a time change at the
Yeah,
moment.
that's a great point, and it just showcases the amount of specialization and knowledge required to run a merger arbitrage strategy because there's just so much to worry about. And in Kellanova, yes, they got HSR, which was great, and then the Europeans are like, wait a minute, they hold the
Yeah.
deal. So there's just so much to be aware of and so much to monitor and know. And yeah, it's complex.
Yeah, with Ferrero wanting to now acquire WK Kellogg, hopefully, we let them do that and they let us do this one, and then we're all going to be happy.
Yeah, and then there's political considerations because, during the Lina Khan FTC, there were accusations of collusion with the UK regulators.
Yep, I remember
So
that.
that's kind of a whole new ball game under that type of extremely hostile FTC, and you could argue the DOJ as well. And then you've also seen, unprecedented events at the FTC and that Trump firing, the Democratic commissioners, them going down to 3 commissioners, which I don't think had happened in 80 years or whatever. And now the court rules that, in fact, it was illegal. And now one Democratic commissioner coming back and the other just quit because he said he needed a job. So it's just kind of the reason I like it so much is seemingly new thing every day. It's not like a dentist where people's teeth aren't going to change. Like merger arbitrage is constantly changing and evolving. And then, over the past probably even just half dozen years, the growth of the SPAC market has introduced also a whole new ball game in terms of options on how arbitrageurs can allocate capital.
Absolutely. So, Julian, one more follow-up question there. I've looked at funds that, as you mentioned, do every single arb deal. You are most selective. So, let's say there are 80 to 100 deals, at least in the US, that are active at any given point in time. How diversified are you? And how many of those deals would you say potentially participate in out of 100 deals? Is that more like 30 deals? Are you that selective, or is it a little bit broader or narrower than that?
So a couple comments on that. I just wanted to address kind of active versus passive, because if you look at large cap US equities, most people think that, the passive ETF S&P 500 is the better option. And if you look at the analysis, my thoughts are that, the Standard & Poor's portfolio management team running, they call it the S&P 500 fund. In my opinion, it's an active fund. It just has low fees and very good branding. They're a top quartile manager, and it's tough to beat them if you're going to be active. Now, conversely, Standard & Poor's also has a merger arbitrage index. So they have a passive index tracking merger arb. And I joke that it's one of the easiest bogeys out there. And the vast majority of active merger arb managers handily beat that index every year. I think we've beaten it by probably 700 basis points per year. So absolutely just crushed that index. And I don't think there's ever been a year where we didn't beat it. So merger arbitrage is dramatically different in that active managers, most of them beat the passive index pretty handily because there's some major problems with the passive index. So being market cap weighted in merger arbitrage is a bad idea because the largest deals, number one, face the most regulatory risk. And number two, not only do they have the largest deal break risk, but they have delay risk as well. So that timing risk is important. We all know what happens on a deal break, you lose money. And the name of the game in merger arbitrage is to not lose money because that sets you back. You make money on 10 deals, you give it all back on one deal break. So the number one job is to not lose money on any one investment. And then number two, if you have a deal that is supposed to close in 6 months and you're going to earn a 5% gross spread, that's 10% annualized. That's a great return. However, if the deal ends up taking a year because it gets delayed due to regulatory, it's much less attractive, right? And those two combined make it such that the passive market cap approach is a poor way to run a merger arbitrage strategy. At Accelerate, we ran an analysis that looked at deal break percent by deal size. And it's pretty dramatic. Like if you look at historically, about 6% of transactions fail. We're talking about US M&A. And that's going all the way back to, I think, around 2010. So last 15 years of data. 94% are successful, 6% fail. But large cap deals over 10 billion, that goes up to 15%. So they're much more likely to terminate. Not saying you shouldn't invest in large cap deals. The point being is they face higher risk, more likely to fail and lose money. And if we talk about most of these deals that faced issues, ANSYS, Juniper, Hess, US Steel, it's not like we wouldn't invest in these, but basically all of these were delayed far longer than expected just due to that regulatory risk. And you faced a tremendous amount of volatility over the deal cycle. So that's one thing, just in terms of the passive approach. I think it's not the best approach. Now, on how selective we are, if I look at our current merger book, we generally have, call it 15 to 20 deals in North America. That would be out of kind of 80 to 90 outstanding at any one point in time. So we're pretty selective in that we generally have on about 25% or less of the outstanding public definitive agreements in North America as positions.
Got it. That makes a lot of sense.
Yeah. We've kind of been picking at this question here and there, talking about precedent transactions and a lot of similar case studies in the past. But could you talk about any specific investment or position that has worked out super well for you in either of your funds or strategies? And what did you learn from that, most importantly?
Wow. There's like so many I could talk about, and a few that haven't worked out that I obviously remember as well. And obviously the best ones on merger arbitrage is when there's a competitive bidding war for a target. That is, if you miss one of those in merger arbitrage, you're going to lag behind significantly. And if you hit on that, where there's two buyers going head to head, and the target, you're just, like I always say, if you're in one of those situations, hang on for the ride and don't sell until it's over, because that's the best thing you could ever expect in a traditional merger arb transaction. So any of those we're super happy about if you get a much higher return than expected. Any particular one, they tend to happen on sort of smaller deals. Continental Gold was a Canadian listed miner that had a lot of upside because you had a Chinese buyer come in and really push up the price significantly. As for other ones there, I'm just trying to think.
Was there Straight Path Communications? Verizon and AT&T were going after that?
Yeah, so they had the Spectrum, just a vicious bidding war where the end result was like multiples of the initial price. So a huge win. If you're in that one, you're extremely happy. And then I'd be remiss if I didn't mention the tremendous upside available in SPAC arbitrage. So our goal in SPAC arbitrage is we buy the IPO at $10. Typically that comes with, $10 or more in trust, which they invest in treasuries. And typically a right or a warrant is a sweetener. And the SPAC sponsor generally has 2 years to do a merger. And if they don't, then you get $10 plus interest. So it's basically like owning a treasury bill that's tax efficient because they're Cayman domiciled. And if they do announce a deal, the real juice in that strategy is if the merger is deemed attractive by the market, it'll trade significantly above cash value, allowing you to exit at a large premium. So one recent example, a couple months ago, Cantor Equity Partners, CEP, which we participated in the IPO and we're just holding. Then one day they announced the merger with 21 Capital, which was one of these Bitcoin treasury companies, which are all the rage these days. And it traded as high as $50. So I've never seen a low risk merger arbitrage deal where you get like where you expect upside of 50 cents and you end up getting upside of $40. The upside optionality is just tremendous. I mean, we didn't sell at the exact top, but we sold in the 30s, so I had upside of over 200%, which is exceptional. We love that type of transaction. Another good one we were in was during the last SPAC boom in 2020, 2021. We're in the Churchill SPAC, CCIV, that announced a merger with Lucid. I believe that one also went into the 50s, up from $10 where we bought the IPO. So some of those SPACs, while most are duds, you want to take a basket approach to that strategy, buying the IPO and just wait, because some of them turn into absolute lottery tickets where you can just get explosive upside returns, while most importantly, having that downside capital preservation just through the redemption right of the SPAC.
Got it. Yeah. I was listening to your recent podcast with, I think, Vic Mittal about crypto treasury companies. A lot of people who follow merger arb or risk arbitrage don't necessarily focus so much on crypto and especially crypto treasuries. And I noticed the big jump in that SPAC that you mentioned with the crypto treasury company. So just for
Yeah.
folks who are not that familiar with what that means, Julian, could you help us understand what a crypto treasury company is and why these are so popular these days?
Yeah, and so to understand crypto treasury companies, just look to MSTR, formerly known as MicroStrategy, now known as Strategy, and they're run by a
Yeah.
guy named Michael Saylor, who in 2020 discovered Bitcoin and became religious about it and a huge advocate. He put in 2020 $250 million of MSTR's corporate cash into Bitcoin, and it really took off. And largely
Yep.
retail investors loved it and kept buying the stock. So they issued more stock and bought more Bitcoin, and ultimately started calling themselves not a software company, but a Bitcoin treasury company, and traded way above the net asset value of their Bitcoins. For example, they own about, I think, over 60 billion of Bitcoin, but their market value is basically double that. So other entrepreneurs and business people recognize that and see the opportunity where they could emulate that. And hundreds of companies have sought to emulate that structure globally across, various stock markets worldwide and various cryptocurrencies, whether it's Ethereum or there's a Litecoin announced this morning, or Solana, and so on and so forth. So it's just a publicly traded corporation that owns crypto, usually using both common equity and debt. And right now, the market loves it. Who knows how long that's going to last, but for now, that's the situation.
And then how did that play into the SPAC world as well? What are you seeing there in the more recent SPACs around this crypto strategy?
Yeah, so there's voracious demand right now, just given the price action in the crypto space, which is very bullish on crypto related companies. And several SPACs are utilizing that structure to announce new crypto treasury companies. We saw 21 Capital, we saw, ProCap do one, we see Reserve One recently announced one. So it's proliferating where entrepreneurs are starting new crypto treasury companies and bringing them to the public markets through the SPAC structure. And typically they're trading quite well.
As you mentioned, there was a big boom of SPACs back in 2020, 2021. And to some extent, we're seeing another upswing in SPACs once again. Is there any ways you're approaching investing in SPACs or SPAC arbitrage differently this time around? And if so, how?
I don't think we're doing anything differently. The name of the game is to just, buy at the IPO, take a diversified approach, support the sponsor throughout the process, and then hope that they announce a good merger deal worst case scenario is they liquidate, your warrants and rights are worthless, and you get your $10 back plus accrued interest. So, we try to focus on better sponsors, top tier sponsors, but as the SPAC market has come back, it's become much more competitive to get good allocations within IPOs. So it's all a balance. And our approach has always been quite consistent.
And is there anything that in particular that defines the approach in addition to looking for good sponsors?
Not necessarily. I don't think there's any magic behind it. You just need a good model and your eye on the market and your understanding of the market. And you can do well if you have relationships with all the underwriters and get the deal flow to be able to participate, which admittedly isn't really available for individual investors, but it's kind of where we provide some value there.
Got it. So, Julian, I wanted to talk about interesting recent deal that had a very large spread. So this is the CoreWeave deal where they're acquiring Core Scientific. And after the deal was announced, and this is an all-stock deal, the spread was as large as 40%, and I've seen it come down to close to 16% now. So I was just wondering, when you look at a situation like this, I know we've kind of had a difficult time with some of these all-stock deals, and you mentioned that when there's a vote on the buyer's side, that is a red flag for you. But when you see such a large spread on a deal like this, how do you think about it? How would you approach a deal like this? Would you consider trading it? And then what kind of precautions would you take, considering CoreWeave has been public only for a few months now, and both of them operate in a highly volatile area of cryptocurrency, if you will?
A lot of cores, CoreWeave, Core Scientific. So interesting deal, and clearly there's been interest there in a while strategically. It does make sense, and CoreWeave had a pretty tremendous valuation just given the amount the shares rallied. So I always view those deals as you're kind of paying with monopoly money because the market gave you this incredible valuation. It was up like threefold from the recent IPO. So they can, do accretive deals or kind of buy what they want, just issuing paper. So a very advantageous point that they're at. Granted, that can disappear pretty quickly. And the other thing that's driving it, it was a low float IPO, which contributes to several dynamics. So number one, in evaluating a transaction, if there is a buy side vote, that doesn't mean, end of story there, because there's certain mitigating factors, particularly if there's controlling shareholders, either through a large stake in the company or through multiple voting shares, because there could, if there's a controlling shareholder, then you're isolated from that hostile takeover risk for the most part, particularly if they've already consented to the merger. And it eliminates this activist scenario where they reverse the spread and agitate against the deal and have it terminate. So you do need to look at shareholder dynamics and look for a controlling shareholder who really kind of runs the show on the acquirer. Then with respect to CoreWeave in this low float IPO means there weren't a lot of shares to borrow. And when the deal got announced, we modeled it out. And a core component of an all share deal is you buy the target and you short the acquirer. To short the acquirer, you need to borrow the shares, and you go to your securities lending desk and you say, oh, what's the borrow rate on this one? So the morning that got announced, we modeled it out. We asked the securities lending desk, what's the borrow rate? And they come back with, this one's not so good, 300%.
Indeed.
To give you a sense of how egregious that is, typically to borrow stocks like, 55 basis points. So 300% was astronomical. And that just made the spread completely uneconomical. So even at that, 20 or 40% gross spread, it's deeply negative because the cost of the borrow way exceeds that. And I remember tweeting the day that was announced, I said, okay, no arbitrager is going to come here and buy the spread and keep it sort of in line because it's just inactionable due to lack of borrow on the leg that you need to short. And that's what you've seen, a very volatile spread because really no one's trading it.
Yeah, and this one reminded me of another one, which was a DVD rental company. I think it was Red Box that was acquired by Chicken Soup for the Soul Entertainment. Fascinating
Yes.
name. And that had a similar situation. It was an all stock deal with a massive spread, and you just couldn't capture the spread because there wasn't enough borrow available, no liquidity, and the borrowing cost was so high.
Yeah, and that deal in particular, the chicken soup briefly became a meme stock. And that's what blew out the spread. So if you're short that, you're in for a world of pain in addition to paying egregious borrow costs. However, it is worthwhile to consider if you are a shareholder where you can capitalize this. If you're a shareholder of the acquirer, for example, in this case, CoreWeave, and you're comfortable with the deal risk and the deal going through, it's a no-brainer to swap from the pricier shares to the cheaper ones, i.e. selling the acquirer to buy the target.
Yeah, and the way that whole thing ended with Chicken Soup was the combined company ended up going bankrupt because it wasn't much to that whole deal anyways, but it was this meme stock situation.
Figured a chicken soup company buying a DVD kiosk rentals would be a recipe for success, but I don't.
Indeed.
Julian, I've been reading through some of your recent posts, and I believe one of the more recent ones dived into how retail trading has very much caused this big shift in markets where like traditional fundamentals share this stage with social media buzz and brand familiarity, was something you were saying. In that post, you talk a lot about this 6-minute retail trading research window. Could you dive a little bit into that for our viewers who might not be familiar with the concept?
Yes, so a research report came out by some academics, some finance professors, where they studied the behavior of retail investors. And what they discovered is for the median retail investors spent 6 minutes researching a stock prior to buying it. So not a lot of due diligence, unless they're much smarter than me, but I definitely can't do a lot of due diligence in 6 minutes, although I am pretty proficient. And the majority of this due diligence was reading like an analyst recommendation or watching like a YouTube video. So they're not necessarily reading the 10Ks or anything of that nature. And it just goes to show you that not a lot of thought or analysis, more specifically fundamental analysis, and going into security selection by retail, which is important because retail is now estimated to be, between a third and a half of all US stock trading volume. So it's a huge force. And I say, I'm not disparaging retail, but I'm saying it's this massive contingent of individuals in the market that add up to millions of different accounts that can get together. Not necessarily, well, maybe it is manipulating stocks, but they can form these big groups and really push around securities in the market. We saw it with meme stocks, we saw it with GameStop. That's a really new phenomenon where you have retail investors, millions of them, fortifying and joining up on platforms like Reddit, where if you're on the wrong side of that trade, you can get rolled over, like run over pretty badly. And you saw it with various hedge funds who are short GameStop 5 years ago or so. And it's this new dynamic that one must be very aware of because I think retail investors deserve respect due to their power. Not individually, but combined, they're very powerful. And if you're not careful, they can cause some serious damage. And where this goes to is they can cause wicked stock moves, particularly in kind of smaller names, where if you're short, you got to be very, very aware of this dynamic because, whether it's AMC or GameStop, or these days, a crypto treasury company, you can get hurt very badly on those. So just to be aware that if you are trained in traditional academic financial theory and efficient market hypothesis, that entire chapter has been completely rewritten because this is not efficient markets. Mm-hmm. They are buying securities not on their view of its undervalued or some fundamental view, their view is, oh, other people on Reddit are buying this. I saw TikTok, they're buying this, and it'll be fun to participate, right? Which is completely different than, rational fundamental analysis. And efficient market hypothesis is based on the assumption that investors are rational. And this whole new dynamic indicates that there's a huge contingent that is not rational based on fundamentals. And that's important because the market has gotten actually more inefficient. And that's not to say that because the market's inefficient, it's easier to make money, because that's not the case. I don't think there's any correlation between inefficiency and money-making opportunities, but it's just something to be aware of.
Yeah, because those inefficiencies can last a really long time.
Yeah, look at GameStop. Like, that stock remains elevated 5 years later. Can you explain that? No, I don't know. I can't make money off that, right? It's inexplicable and difficult to understand.
Indeed.
So, do you think there is a path for these professional investors to take advantage of these inefficiencies or this irrational general mindset in the market, or is it best to stay away and pull back?
I think you can, because with more inefficiencies, it does create more opportunities. Like, if the market was completely efficient, like, many people complain about inefficiencies and crazy stuff happening and short squeezes, but if markets were completely efficient, none of us could make money, right? So given these opportunities are out there, clearly, it's a godsend that there are inefficiencies and, people willing to lose money for whatever reason, or willing to trade options at huge spreads. So there's just ability to make money just by basic market making, bid-ask spreads, and being passive. And then there's, we gave the SPAC example. That's institutions making money off retail investor excitement. Those are just basic stuff where you can act as a liquidity provider and get compensated very well on that without having to make any sort of fundamental calls. So yes, there are very good opportunities to capitalize on that dynamic.
Indeed. So for every GameStop, there were companies like AMC that did come down back to earth, or Lucid or Nikola. So yeah, there are a few that kind of escaped gravity, if you will, but the rest of them did come back down to earth. So Julian, we're going to wrap up with a couple of rapid fire questions that we ask all our guests. Is there a book that you've read that you keep coming back to from time to time? Or are there specific podcasts that you like to listen to often?
Yeah, in terms of books, read as much as you can. One of my favorite ones, not the best name, but it's called You Can Be a Stock Market Genius by Joel Greenblatt. That's sort of classic for special situations investors. And that'll give you the basics of interesting types of trades that you could look into. Of course, the Warren Buffett letters, Seth Klarman's Margin of Safety. Granted, you can't really buy that book. You can find the PDF online. Peter Lynch's books, Beat the Street, One Up on Wall Street. Those are good for more sort of growth style investing. Fisher, who else? There's just a ton out there. And, I always joke that I think I've read every book. And so I got a pretty good library of finance books, because that's basically all I read. So just, start and never stop, and just keep reading everything that's out there. And there's a ton of stuff to learn online, like the explosion of material just through like tweets or blog posts are very instructive. Yeah, I listen to as many podcasts as I can. I used to be, like, long ago, active participant in like online forums. Like, I was a member of Value Investors Club, probably 2010 to 2020. I would be very active on there. I haven't been on there in a long time, but that's a good resource, particularly when you're kind of newer to investing or earlier on in your career and looking for idea generation. And then the best thing, it's kind of like learning a language. you learn by doing, and it's the same thing for investing. The best way to learn is just by doing, but certainly learn strategies by reading about them, learning from others' mistakes particularly.
Yeah, you can be a stock market genius is certainly a personal favorite of mine. And I remember when I was talking to my publishers about writing a book on event-driven investing, one of the things I told them was, it's been 25 years since you can be a stock market genius came out, and there hasn't been much in the space written since then. And so that was one of the things that got them to greenlight the book.
So I read your book. That was great. Greenblatt's other book, little book that beats the market. That's more kind of a basic on systematic and quant investing. Also very good investment book. And then, there's books on risk arbitrage, convertible arbitrage. Weiser Pratt wrote a good one on risk arbitrage. And there's other books on merger arbitrage. There's not a lot. There's like a small handful. There's others. Calamos is a good one on convert investing. And I'd have to consult my library, but there's just so many. And the classic, Ben Graham and Dodd type investing, security analysis, intelligent investor. You got to read the classics just to kind of get that baseline fundamental. They may not be as applicable today. Not a lot of people doing net style investing, unless you're maybe a biotech investor where there's a lot of those. But it's worthwhile definitely reading all those classics, Graham, Fisher, etc.
That was a great insight. We'll wrap up with our last rapid fire question. Another one is, what is something that you like to do in your free time, perhaps not even related to finance?
Yeah, it's always encourage people to have a hobby outside of investing. It can get very stressful, I'd say, particularly as a professional investor. There's business challenges, performance challenges, position going against you, getting squeezed on a short, or FTC's looking to block a deal, and you work a ton as well. It's not a job for someone seeking work-life balance or a good lifestyle. Certainly, you got to work super hard and work very long hours under extreme stress, not get a lot of sleep. So one release valve, I think, is kind of physical activities. So I do like to stay active, whether it's lifting weights. I do like some combat sports, particularly jiu-jitsu. Try to do that as much as I can. Muay Thai, MMA. I like training all those. That's fun. And then snowboarding in the winter is another activity I like. It's basically all I have time for.
So combat with the markets all day, every day, and then you go combat with people to get some of that stress out. Makes a lot of sense, Julian.
Healthy body, healthy mind.
Yeah.
The better health that you're in. So that means, granted, we don't get a lot of sleep, but try not to be overtired, try to eat healthy, have a clean diet, and, be strong and fit, because better physical shape you're in, the sharper your mind will be. And I truly believe that there's a correlation between, physical shape and mental shape, not just in terms of, consistency and accuracy, but longevity too. If you want to do this a long time, it's you're operating under extreme stress consistently, and if you're overweight or have health problems, then things can end up very poorly.
Makes sense. Julian, thank you so much for this wonderful conversation. We really had a great time and learned so much from you and the way you approach this whole process. So it was just absolutely a delight to have you on today.
Thanks so much for having me. I appreciate it.
Excellent.
And that wraps up episode 30 of the Special Situations Report. It was absolutely wonderful having Julian on as our guest for this week, and we'll continue with regular programming in the weeks following. However, if you'd like to access a comprehensive weekly overview of all event-driven activity, go ahead and visit our website, thespecialsituationsreport.com. For daily updates and alerts on this special situations world, as well as access to tools to help you identify opportunities, such as the merger arbitrage tool, check out insidearbitrage.com.
If you enjoyed this podcast, please take a moment to like and subscribe on whatever platform you may be listening on, and especially share it with your friends who are interested in special situations. Thank you.